Quick test. If I told you a company made $100 of profit, would you tell me right away what happened to cash or equity? If your answer was, kinda, stick around. Before you touch Excel, you need to feel the heartbeat of every model: the income statement, the balance sheet, and the cash flow. Give me a few minutes and I'll wire them straight into your brain. Let's start with a bold statement. The balance sheet is the mother of all statements. Why? Because everything that happens in a business will show up there somehow, sometime. Even the income statement and the cash flow statement are just explaining changes to lines of the balance sheet. But I won't just tell you that, I'll show you. Before we dive in, a quick reminder. Every impact in the balance sheet balances the accounting equation. Always. Assets equals liability plus equity. That's the accounting equation. But don't worry, you don't need to memorize it. Once you understand the logic behind it, you'll never forget it again. Let's start with a simple balance sheet. So here we have the assets and the liabilities and the equity. And you see here that the equation is balanced. So whatever we have in the total assets equals whatever we have in total liabilities plus equity. Now, if we decide to buy some equipment, for example, we are going to buy here in machinery. Instead of 100, I'll put 200. You see that right away, my cash is going to go down because I'm moving from here to here. And it doesn't change my equation. It's still balanced. So let me say that I am going to get a loan and get some money here on my liabilities. I will increase my loan in 100. So let's put 200 right here. You see that right away, this $100,000, $100, whatever it is back to my cash account. My balance sheet is still balanced. So let's say that instead of receiving the money right away from my customers, I delayed the receivables a little bit. So I sent some of the cash to accounts receivable. I will increase my accounts receivable. So let's say that instead of 180 in accounts receivable, I would have 250. You would see right away that my cash is going to go down because I am delaying the receivables. At the same time, if I decide not to pay my vendors right away, if I want to increase my accounts payable to, let's say, 100, you see that my cash is going to go up at the same proportion. And my balance sheet still balances. You might ask me, yes, but when I start selling things, when I start making profit, I might need an income statement. Yes, you're right. We need an income statement. The income statement shows us the detail of profit. So let's take a look at the income statement. We have here the revenue, the cost, which brings us to the gross profit. Then we have expenses, interest, depreciation, which bring us to the taxable income. We pay taxes, and we end up with the net profit. So let's see what happens if we increase this revenue a little bit. Instead of 524, I would have 624. You see that my cost goes up a little bit, my gross profit goes up a little bit, and all the way down, I'll pay more taxes, and I'll end up with another net profit. This net profit is going to come straight to my retained earnings. At the same time that I'm increasing my net profit, I'm also increasing my equity. So I already proved you that whatever happens in the income statement also happens in the balance sheet, affects directly the balance sheet. On the other side, everything that I'm doing here on the income statement, almost everything, is related to cash. I am receiving cash, I am spending cash. So all of this also goes back straight to my cash and equivalent. Let's try that again and see and watch the cash right now. I'm going to change this to 724. Once I do that, my cash also increases. So to reconcile my income statement, to reconcile my net profit all the way to my ending cash, that's why I have the cash flow statement. So let's take a look at the cash flow statement. I will begin with my net income and I will make all the adjustments, everything that goes in and out my cash account, all the way down to the ending cash. So in the net income, you know that there are some lines that are not cash related. Depreciation is one example. And also, when I decided not to receive cash right away, I'm just moving things around in my balance sheet. So here I'm going to start with the net income and I will adjust all of those lines that are non-cash until we get back to the ending cash. So everything that is non-cash, I'll put it back. Everything that is cash, like capex or whatever I get from equity or a loan, debit, or whatever else I have in my cash account, will come here until I have the cash movements, and then I end up with my ending cash. And as you probably guessed, the ending cash goes straight to my balance sheet. That's what we see there in the first line of my assets. So, did I prove to you that everything that happens in those statements happens in the balance sheet? Everything that happens in the income statement affects directly the retained earnings, which affects the equity, and everything that happens in the cash flow statement affects directly the assets. So it goes straight to my cash line in the balance sheet. And that's how the three statements connect. Do you see now why I say the balance sheet is the mother of all statements? Everything connects back to it. Cash, debt, inventory, profit, it's all part of one system. If your balance sheet isn't balancing, something got lost in the story. This is why building a model isn't just about entering numbers. It's about creating a living system. When you understand how the statements connect, you stop guessing and you start diagnosing. You will know exactly how net income flows into equity and how changes in the working capital affects cash. That's when your model starts telling you a real story of the business. So next time you open a model or start building one from scratch, look beyond the layout. Feel how the statements talk to each other. Because when you master the connection, you're not just modeling, you're thinking systematically. If you want to see how this plays in financial modeling, don't miss my next video. I will show you exactly how to make this connection right as we start modeling, so your model is dynamic and integrated. I'll see you in the next one.